If governments were companies, many would be borrowing just to keep the lights on. We'll look at how big the borrowing is in the US and what that all means for you, the regular investor. What the numbers look like. When a government's spending is more than its income, you get a deficit. That means the government has to borrow money to cover the extra. If the cost to borrow keeps going up, that's a growing burden. The US ran a $1.83 trillion deficit in 2024, around 6.4% of GDP. The debt to GDP ratio is about 125%, and total debt has surpassed $38 trillion, which is roughly the economies of China, Germany, Japan, India, and the UK combined. The interest rate the US government pays on its debt has been increasing, and by 2024, interest payments had grown to about 13% of total government spending, over $1 trillion last year. So the US government is having to borrow more, and at higher cost than it once did. Why deficits have been building? Here are the big forces that have widened that gap between spending and income. 1. Aging populations. More retirees mean higher costs for pensions and healthcare, but fewer working adults to pay taxes. 2. Higher interest rates. After years of near zero borrowing costs, governments now have to refinance old, cheap debt at much higher rates. 3. Crises and emergencies. From the 2008 financial crash to COVID-19 and the energy shocks, every crisis meant trillions in extra spending. 4. Policy choices. Tax cuts and subsidies often sound good politically, but when not paired with spending cuts, they deepen the deficit. 5. Increased spending that doesn't grow the economy. Some of the biggest chunks of government budgets go into military spending, weapons, and wars, areas that may not directly create long-term jobs, productivity, or tax revenue. It's money flowing out, not necessarily money that comes back in. 6. Slower growth in mature economies. US has struggled with lower productivity as expected by developed economies, so tax revenue can't keep up. Put simply, higher cost, slower income, and a lot of spending that doesn't generate returns. The result? More debt every year. High debt, real risks. What it means for ordinary investors. Debt itself isn't evil, it's how it's used. Borrowing to build roads, ports, or technology can grow the economy. Borrowing to pay interest, however, is like taking a loan to pay your credit card bill. The US government now spends a huge portion of the budget just on interest payments. That means less money for infrastructure, schools, healthcare, or tax relief. And the government borrows from the same pool of investors as companies. Higher government borrowing can push interest rates up for everyone, including you, your mortgage, your business loans, and even the valuation of your stocks. What this means for ordinary investors. So, what should you take away as an investor? 1. Government debt and interest rates affect your returns. When governments borrow more, they issue more bonds. To attract investors, they have to offer higher yields. When new bonds pay higher interest, the old ones lose value. If you bought a 10-year US bond 2 years ago paying 2%, and today new ones pay 5%, no one will buy yours at full price. They'd rather buy the 5%. That's why many bond funds have fallen in value recently. 2. Don't assume government bonds are risk-free. They're safe from default, but not from loss. If interest rates stay high or go higher, the market value of your bond investments drops. 3. What it means for stocks. Higher borrowing costs make it more expensive for companies to fund growth. Profits can shrink, valuations fall, and investors become more cautious. This doesn't mean you should sell everything, but it means focus on companies with strong free cash flow, low debt, and essential products people keep buying even in downturns. 4. Inflation and taxes. When governments owe too much, two things often happen. They may quietly let inflation stay higher, which reduces the real value of debt, or they raise taxes on income, capital gains, or corporations. Either way, investors lose a slice of their real returns. 5. Currency angle. Unlike before, the US dollar has started to depreciate against several major currencies as deficits balloon. That means if you're investing internationally, holding a mix of currencies or assets that benefit from a weaker dollar and could help balance your portfolio. In simple terms, for a normal investor, If you have bond funds, ask, what's the average maturity/duration of the fund? Shorter duration means less price drop if rates rise. Consider mixing some bond exposure with shorter maturities, which are less sensitive to rate rises, and some with inflation protection, if inflation borrowing costs stay high. On the equity side, companies with strong free cash flows, little debt, and global diversification may weather higher rates better than highly leveraged or speculative firms. Be mindful that if governments pay more interest, they might raise taxes or cut growth-boosting programs, which could affect corporate profits and your dividends. Another practical point, holding some cash or very short-term bonds isn't a bad idea. It gives you the option to redeploy when valuations improve, rather than being fully locked in at high risk. High debt doesn't mean an immediate crisis, but it does mean the tide has turned. Governments are paying more to borrow, and investors can't ignore that. If the 2010s were about chasing growth at any cost, the 2020s are about learning to live with debt. Build a portfolio that survives both higher for longer rates and growth slowdowns, and let policy noise nudge your allocations, not dictate them.